Thank you for joining us. I'm Gord Long. It's my pleasure to have with me this morning Charles Hugh Smith, well-known and very prolific writer on the web, who is the publisher of the extremely well-followed website of2minds.com, and also a longtime co-host with me here at Macro Analytics. Welcome back, Charles.
Thank you, Gordon. Always my pleasure to be on the program with you.
More probably your biggest pleasure is you're in Hawaii again. Enjoying that. But the weather's better here in Boston. We have beach weather, so I'm not quite as envious as I am typically when you're coming from there. Charles, I'm going to jump right in. We're always short of time on these videos, and I do have to apologize to our listeners. We are doing a podcast here today because I had some technical difficulties on my end. But I think we'll be back fine next month. I just didn't want to make sure that we had a chance to record some of the great slides that we put together here for this session. Charles, we're going to talk about this road to financialization, and you've written extensively on financialization over quite a number of years here now. But I thought we'd go through these agenda item here of a sequence of things to bring it into perspective who may have not been following it for this length of time, as long as we have. And and try and put it into perspective. And the first chart, just as a baseline for everybody to fully recognize, is the degree of debt growth, credit growth, debt to GDP growth we've had. How it's now going geometric, parabolic, and accelerating at a great rate. I think very few of our listeners would be a surprise. The question is why? Why is it? What triggered this? What's making it happen, and where does it end? And so in that regard, I wanted to take us through a roadmap where we kind of put some timelines on that, on your chart here of this exponential growth. Any comments before we go to the details?
No, Gordon, I think the key context for me in financialization is our rising dependence on financialization, which is the debt and leverage, just to keep the economy at neutral, just basically going along at very low rates of growth. We have to keep expanding debt and leverage at higher and higher rates, and so that's a very destructive process, because financialization ultimately hollows out the real economy, and that's what we're going to describe how we got to that process where we're eating our seed corn just to maintain the status quo.
That's precisely the right analogy, actually, Charles. As a farmer, you can't eat all your corn. You have to keep a fair bit of it in the granary for next year's crop, and that's called your seed corn. And you can be fat and lazy if you eat it all this year, but you have no crop next year. And so what happens is we went along in financialization. We're eating more and more and more of our seed corn every single year, so that there's less available to plant in the fields to increase productivity and to increase our standard of living. And that's the trap we got in. How do we get in that trap? And the capitalist system is based on a whole premise that by having competition you get more for less. And what happens is if you do something wrong and you start to break away from that, you end up getting less for more, kind of like our seed corn example with the farmer. And I challenge all our listeners to kind of think about, are we getting a lot less for costing us a lot more nowadays than you had a few years ago, or certainly for those who can remember 20 years ago? And I think you clearly found out that the answer is yes. And what happened, what got us on this track, and nobody's ever survived it, Charles, as you well know. No economy that moved from sound money ever survived it without the actually destroying the economy. It doesn't mean it has to be that way, but it always is that way, and it's a fact. It's a function of human nature. And so what triggered it? And you can see right here in the bottom left-hand corner, it happened in August of 1971, when President Richard Nixon took us off the gold standard. And it's not about gold. It's the discipline that any item that has limited supply, let's use gold, it forces you to live within your means. That is, you have to produce more than you consume, or at least make it equal. And if you don't have any kind of restrictions, then all of a sudden you start to potentially consume more than you produce. So We went off the sound money. We went to off the gold standard. So we went to a fiat currency, which allowed us to print with limited discipline in increasing the money supply initially. Initially, that's what started to happen. Comments, Charles?
Well, Gordon, I think that my sort of comment to at this point is how we're going to describe a series of steps that look like baby steps. In other words, or they don't look that consequential, because everything seems to be going along after the key pivot has occurred. It seems like, well, everything's more or less the same. It's nothing's really changed, but beneath the surface, there's been massive changes, and so the consequences pile up as we go through these pivots, and so
the cracks in the dam just get bigger and bigger, because
right.
the dam itself is becoming weaker.
Right.
So the actions you have to take become even more dramatic.
Yes.
So something that seems absurd 10 years ago suddenly becomes logical today. Thinking that we would have something like quantitative easing and zero interest rates 20 years ago, you'd be laughed off as being a quack. There was no way that anybody would ever tolerate that. Now we accept it. So it's amazing what you get to accept. But it starts, as you correctly points out, starts very slowly, and then it's forced into accelerating. Because it goes back to what underpinned. I said it started when we took ourselves off the gold standard. Well, the question is, what triggered us to go off the gold standard? And the answer is, we were consuming more than we were producing, and we couldn't pay our bills, and we had to figure out how to get over it. Why were we consuming more than we produced? Suddenly, it's because during this era we had the Vietnam War and Johnson's Great Society, and these were two massive consumptions. To us, we don't think of them as consumption. We can consider them possibly waste. But when you have a fixed amount, when you have a fixed economy, fixed amount of money, it's consumption that you've just chosen, at least our elected officials chose on our behalf, to spend our money in a certain way. So it's consumption. And in the case of the Vietnam War, it was the very first war that we put on our credit card. We had always, war was an ungodly process financially, having to raise bonds, having to get, it was just a massive job of raising money or borrowing money, making obligations to pay for it. This was the first one. We just said, no, we're just going to charge it. And suddenly our consumption went through the roof. Agree with me there, Charles?
Right, Gordon. And in macroeconomics, we talk about guns or butter, because normally society can only choose social welfare programs, the butter, or it can choose to fight a vast war, the guns. And so in the late 60s, we chose guns and butter. And so we put it all on credit. And that leads to the second item, which I think very few people understand. And I've certainly learned something from your presentation on the global balance of payments. The way that we paid for our trade deficits changed.
Yeah, exactly. That's one of the missing ingredients. When we went off the gold standard in '71, what happened was countries were willing to take suddenly our credit in U.S. dollars, and us having, and our trade balance started to grow much stronger. But everybody else around the world was still settling in gold. We were settling more or less in credit, just with some of our supply countries where we did have a negative trade balance. And it was turning out at this point in time, in the 80s, it was getting to be Japan, a little bit more. But by the time we got, and interest rates, for those who can remember, exploded, and they were up to 19%, as Volcker tried to stop the inflation that brought Jimmy Carter's government right to its knees. It was a terrible time with inflation. Well, he stopped it. Inflation almost, brought our country to its knees in fighting it. But what was hidden behind it, and what really triggered at this point, was we had to get the global economy going. And the way to do that was effectively to stop having to accept in a balance of pay gold transfers. Even though the United States was not doing it, all the other countries were. So that all the other feeder countries to Japan, for example, or Japan was trying to sell to them who couldn't pay, didn't have enough gold, was starting to really crimp the global economy and causing all sorts of problems. So what we did is we changed the balance of payments so that you could use, instead of settling in gold, you could settle in credit. And the credit was and continues to be in US dollars, though even the last 10 years it's even moved to full baskets of various currencies. But what happened then was our problem then became a global problem, because suddenly when and you've written about this extensively, Charles, in terms of the Triffin paradox. When we have a bigger debt, that is a debt that we have, but it's actually a credit for those who are debtor nations that have lent us the money that we owe the money to. So they take that money, that credit, and it is nothing, it could be called bogus because it's just a promise of IOU that we're going to pay it, and we're paying it in US dollars, and what do they value it at? But they put it into their banking system, and suddenly for every dollar that they've got there, this bogus fiat, I'll use the word fiat currency, they can print at least 10 times more money for credit, and suddenly they expand. And every country that gets their dollar can turn on a balance of trade, can suddenly do $10. So money, even originally on a fiat basis, just explodes, and then suddenly everybody starts to get caught in the trap. And this is the big event that really happened in the early 80s, and interest rates started to fall. And interest rates have been falling ever since. And this is part of, and I don't want to go on here too and get off track here, Charles, but part of the mercantile strategy, because people like Japan and subsequently China will realize very, very quickly that the game to play here was, yes, you had a credit and you had this money and you could expand, but the best thing to do was to take a big chunk of this money you were even printing and buy US Treasury bonds. Because if you did that, what you did is you drove interest rates down, so that the interest rates fell in the United States, and if they fell, then consumption became cheaper for Americans who would consume your goods, and therefore would create more debt because we couldn't afford it. They got more money, they bought a certain percentage of the bonds, and just kept driving our interest rates effectively down. It was a strategy. And China saw Japan do it and then adopted it themselves, and most of the Asian tigers did the same thing. And we got trapped into a society that moved to a 70% consumption economy based on this debt. And that all took place right up to about 1990, 1991. Still going on today, as obviously China really came in with the world trade in 2001, but it was accelerating. And it was well in place. Comments there?
Yeah, Gordon, I think the key point to me here in your discussion of the way that the global balance of payments changed is when the U.S. Treasury sells a Treasury bond, that's a form of debt. All right. Then what you're describing is a system in which debt is leveraged on top of debt, and then so we've completely lost any discipline of even quasi sound money, because we're creating debt ourselves, which then other people buy and use as collateral for their own leveraging of debt, 10 times whatever the treasury bond they bought is worth. So we have this debt is leveraging debt. And then we start seeing this process come home. In other words, that's the Triffin's paradox, is this works on a global scale, but it also impacts our domestic economy. And that's where your next items about changes in the way that bank reserves are set, and the dividing wall that Glass-Steagall had put between commercial and investment banking. And so let's talk about those two items.
Yeah, that's where it led to, Charles. But just before we got to that, and you made it, you nailed it with the comment about debt, that where debt actually became an asset. Debt was never an asset; it was a liability, right? But suddenly, what we were doing here effectively by creating debt, it became somebody else's asset. Our debt became their asset, and they turned it into leverage, or because they used it as wealth, as a form of collateral to grow it. So that's fine. But that I won't call it trick, but that thinking was exploding in other fashions at that point, and that was a concept called securitization. And what securitization basically, in the late 70s, early 80s, and certainly as we get into the 90s, was, why don't I take my accounts receivable as a company, which is all debt, and sell it to somebody as an asset-backed security? And they would get the revenue stream, but they would consider it an asset. They were buying my debt. We did it and suddenly housing took off at the same time, because we created something called mortgage-backed securities. In other words, the mortgage which is a debt to us, became somebody else's asset, and an asset that could be borrowed against and leveraged against. And so suddenly, if you had this asset, this debt, you could leverage up and borrow more money. And we had asset-backed commercial paper where corporations were even doing it with short-term money funding. So with this explosion in how we handled our balance sheet, it didn't take long before other things needed to be changed. And we know what happened with housing. Housing really started to take off in the 80s, the 90s, and then just exploded after the dot-com bubble. But Clinton and Bush 1, what they realized was, to get this whole thing going, the banks needed to have more liquidity themselves. And so they were being trapped domestically. So the best way to do it is, bank reserves, they had to have a 10-to-1. So for every $9 they lent out, they had to have $1 they kept. But everybody was moving to money market funds for a little better interest rates. And so the banks, as opposed to just cash deposits, they were putting their money in the bank into money markets. So we came and decided, well, what we'll do, we'll just pass a rule saying, oh, you don't need any bank reserves for if the client, the customer, has chosen to put his money in a money market fund. And suddenly that just changed everything, because the banks didn't need reserves. They could just lend endlessly on this money that was coming in. So that's where you start to see the major inflection here, where it really starts to take off, when we freed up the banks and securitization launched into it. And then as we got later into the decade, into about 1997, we said the banks were just exploding globally, and they were really starting to see themselves as dominant internationally, where we decided, well, we need more capital, more of this false money, and that's when we repealed Glass-Steagall. And that's the separation, where insurance and banks insurance companies, pensions had to be separate from the banking system. In other words, banks weren't allowed to take your money in an insurance policy and turn around and speculate with it. They were leveraging money and assets that weren't theirs. Comments?
Right. Gordon, when we talk about the securitization and the loosening of the bank reserves, what we're talking about is, as you described, is when in the old days you could leverage $1 in a deposit to $10 in a loan, right? Well, that after the changes you describe, bank leverage went up to like 26-to-1. So it more than doubled in the go-go years, right? So that's a huge increase, not in collateral, not the underlying value supporting the whole system. It's an increase in the amount of debt that can be piled on the actual collateral, the actual value. And then what the securitization did was it allowed the banks, the investment banks, to offload the risk. So that's when we started to hear stories about pension funds in Norwegian towns, buying these mortgage-backed securities, which had been designed to fail, to be toxic, right? Because they held extremely high-risk mortgages that were doomed to default. But the bank didn't suffer any loss at all, because they'd offloaded the entire risk of the mortgage-backed security onto another investor. So what you've got is a very subtle process. Like I said, it seems to be baby steps that don't seem to have a lot of consequence. But as everybody jumps in to maximize their profits with this new opportunity, what we see is the risk that used to be corralled inside the banking system. In other words, when a bank issued a loan, they were responsible, they took the risk, and they would have to suffer the consequences. That risk was then spread into the entire global financial system, which is why when the subprime mortgage problem in the US blew up in 2008, it quickly spread to the entire global economy. That's the net consequence of financialization.
When it blew up in 2008, 2009, companies such as Fannie Mae had to be put into conservatorship, as you remember, Fannie Mae and Freddie Mac. Because when we went back into this era of securitization, these agencies that were separate from the U.S. government were considered that the U.S., no matter what, would come in and bail them out, or was really effectively responsible for their debt. They didn't have that responsibility theoretically, but everybody kind of knew it. So it was a way of cheap money. So Fannie Mae, Freddie Mac, and even Sallie Mae, and that story's yet to unfold. How they were formed and how they were licensed and what they could do suddenly changed. So in the terms of the housing, these agencies were able to explode, and the money went global, as you point out. Around the world, this was a chance to buy these Freddie Mac, Fannie Mae mortgages, put them on your books, and it was an asset, and then it went into something called rehypothecation, and away we went. And of course, that one blew up in 2008, at least part of it. There's still more to come, in my humble opinion. A big part of also what happened then, Charles, as we got into after the dot-com bubble, and this was a precursor. That just showed you how much money was chasing stocks and items that had no revenue. We were valuing companies on hits, page views, and eyeballs at the time, which was absurd because there was just so much money available in the IPOs. But what happened right after that, as Greenspan dramatically reduced interest rates. We did not have zero interest rates. That's still to come. But we had very low interest rates at that point in 2001, 2003, etc. And the reason we had it then was to try and get the economy going, to get us out from this disaster in the dot-com bubble. Housing subsequently exploded as mortgage rates were brought down. But what was hidden underneath that, Charles, is what I call financial repression 1, and that is we took interest rates down, but inflation was high, so that real interest rates were negative. That creates another set of problems. It allowed the government to finance itself and to create more debt, but able to afford that debt because of the low interest rates, and we're effectively reducing purchasing power through negative real interest rates. And that got worse with financial repression 2, where we took it even the nominal rates down to zero, and then started to buy back bonds to even force the long end of the bonds down even further. But all of this, you see it turning and forcing the acceleration into an exponentially. You'll notice on this next chart, Charles, where a little more granularity of how, because the first one just shows you this going exponentially, but it shows you that the key events were taken when things started to fall off the grid. There was all of a sudden it was reaching some limitations, and something significant had to be done. You can see the money market funds here in 1990 through about 1992, but then the overturn of Glass-Steagall, and then really critically was during the financial crisis, and everybody forgets about this. We overturned mark-to-market. And mark-to-market said all of the derivatives, now we're talking about derivatives, options, swaps, all of these on the banks and all of the financial institutions had to be marked on their books at mark-to-market. So whatever they were, that's what they had to be on their book. Well, to get us out of the crisis, we said, we're going to have a holiday, if you would, on mark-to-market. You could mark to fantasy. You could mark to any excuse that you thought that they were really worth. We reversed it. It was a big cornerstone of what was able to get us out of the 2008 financial crisis, but it was a charade. And maybe it would have been a good idea, possibly. I can't be convinced of it for 12 months, possibly, but we've never reversed it. Now you have the entire financial community betting in derivatives and options and leverage that don't have to mark-to-market. Now your books are not only fallacy with debt as an asset, you don't even know what any of the assets are worth. comments?
Right. No, it's absolutely critical, and I think I just want to highlight what we're seeing here is as financialization hollows out the real economy, the only way to keep it going is to dissolve another barrier of discipline. In other words, whatever discipline exists in the market has to be destroyed, or else the financialization monster eats its own tail and the whole system collapses. And so we got rid of the discipline of sound money. Then we got rid of the discipline of high bank balances. We got rid of the discipline of Glass-Steagall. We got rid of every discipline is being destroyed, and so mark to market was a key element of discipline. And what mark to market means, just to give a simple example, if I own $100,000 mortgage, right? That's a debt, which is my asset, and the person with the mortgage defaults and stops paying the mortgage. Well, the marketplace is going to look at that mortgage as impaired, and they're going to say, the market's going to say, well, maybe that mortgage is worth $50,000 now. It can't be worth the full $100,000 because the owners aren't paying you anything, so it can't be worth the full value. But with mark to market dissolved, I keep the mortgage on my balance sheet as at the full $100,000, even though it's worth less than half of that. So you see, I have no discipline at all. The collateral can go to zero, but I get to keep it on my books at full value. So I've eliminated the last element of discipline in this whole financialization process, which is the market value of the collateral that's holding up all this debt and leverage.
We started this discussion on the discipline that we surrendered, and we also said, we started by saying, capitalism is about having competition. And if you get the competition, you get more for less. But as they start to have problems, then you get less for more. And one of the things that is subtly missing about how you made it easy, you notice over in this chart in the left-hand corner, that about 1982, somewhere in there, we stopped really aggressively stopping monopolies. And for some of us, I grew up in the era when IBM was trying to be broken up by the US government for monopolistic practices. And at the same time, AT&T was they were trying to break them up. Well, they decided to break AT&T up, broke it up into, it was a massive decision, and into what they call the regional Bell operating companies. And then IBM, they decided not to, but it still kind of split itself apart in some ways, and in fact, that's how it did. The point I'm making is these were big events, massive events on the media every single night on whether this was going to happen. The regulatories were all over corporations to make sure there was fair and aggressive competition. Charles, when was the last time you saw a company broken up because of monopolistic activities, even though we have fewer and fewer corporations controlling more and more of the various markets and dominating them? I think you just said the other day there's 7 media corporations or individuals that control the total media industry. So we stopped doing that.
That's
you
right.
Agree with that, or have you seen it? It hasn't. So, because they didn't want to hurt these companies, but these companies become much more dominant, and therefore you lose competition. They start to feed off the government in many ways. So there were so many examples that on the surface could possibly be spun, and that's what it is. It is spin as being a good idea, but are a disaster in the long term. Glass-Steagall overturning that was a massive mistake, no question about it. The not pursuing aggressively and accelerating rate monopolistic activities and breaking up companies where they're why was 2008 too big to fail? Wasn't that the terminology? We should have never allowed the banks to have ever got to the point where they were too big to fail. That was another example of just the mistakes they made.
Yeah, absolutely. And so what we have is we had a systemic failure that was based in the private sector banking, but that they had become so central to this financialized economy that they were untouchable. And so let's move to the last part of your key pivots, where So what did the federal and Federal Reserve authorities do to bail out the financialized economy that was in full-blown collapse in 2008 and early 2009? Well, they did zero interest rate policy, or ZIRP, and QE. So why don't you fill in the blank there on how QE and ZIRP fit into this whole story, of financialization.
See, well, besides creating the whole idea between quantitative easing on this was to increase demand. So suddenly things were becoming more and more expensive. And so we need to lower interest rates, obviously, to even lower, to be able for people to continue to support a 70% consumption economy. But as big as that is, and so we were sold that it was quantitative easing was about bringing demand forward. Well, I think we did sort of a job of that, but everybody needs to realize that on the other side of demand is going to be a hole where demand is not going to be there because you brought it all forward. I think the most evident of that is the car market right now, of the car sales and the inventory glut that we're going to see and what we're going to expect to see in the next 2 years in the auto industry as a direct function of that. But also, and goes back to the comments on Triffin paradox and a global economy and the US dollar, we're no longer working independently. I mean, we all know we're in a global economy, but the central banks have basically lost control of being an entity onto their own. They have to work together. Bernanke's Enrich Thy Neighbor, where they rotated around with various quantitative easing, so that today we're now printing $300 billion a month. Not the Central Federal Reserve, but the other banks. And our day is soon coming. But we needed to do it to keep the global economy going. So quantitative easing wasn't about demand as much. It was also about creating supply. So cheap money in America meant that other countries around the world got that money. About $9 trillion, $10 trillion went to the emerging markets since the financial crisis, borrowed in US dollars that allowed them to expand and to grow. And in their case, to create more supply, more manufacturing facilities, to match increasing demand. But what's happened now, Charles, is we exploded that. Now we've got massive supply. The problem today isn't that we just don't have demand. The problem today is we have so much supply globally that they've now lost pricing power. So the Fed, to keep things going, has got to keep the interest rates down so they can finance the debt. But at the same time, they've got this problem where these corporations are creating deflation by bringing down prices and lack of pricing power, whereas they're trying to fight to get inflation. And how many times have you heard that they want to get it to 2 and 3%, and they're failing miserably? They're creating inflation in assets, but deflation is being created in other areas. And the reason they need this in inflation is to get from, as we talked about earlier, from negative to negative real rates, so that there's a loss of purchasing power, which effectively means they can keep the government, if I can use the word solvent, with their debt, so that the government can continue to fund. But this is the problem we've got. It's a global economy, and the rest of this world has needed the money. So when we cut off the spigot, it created a huge issue, and the other central banks have been picking up the gauntlet ever since, and we will be back in it pretty soon. Comments there or observations?
Right. Well, Gordon, you have a great chart here of financial repression, the road to financialization, showing how the central banks altogether have targeted inflation. There's negative real rates. There's regulations. There's obfuscation of data, gaming of the statistics. All these dynamics actually are put in place to keep the status quo from crumbling, right? That it's like we're talking about, as the cracks in the dam widen, then there's more and more fakery and distortion is required to keep the appearance of stability. the facade of stability up. There's one of the last charts here is a very critical that we need to mention is what has been the result of financialization in terms of wealth and income inequality and social mobility. Well, the net result, as most of us know, is a vast increase in wealth inequality. The rich have gotten immensely richer, and everybody else has gotten poorer.
Well, that's exactly it. That is one of the penalties at the end of the day for playing this game. The Wall Street and Main Street are now two different economies.
Right.
And this has been, and I use Wall Street figuratively, obviously, but those who are in the financial game it's been the greatest 25 years in history. But for anybody that's in the creating real wealth game, it's been a real brutal problem. And for workers who are losing purchasing power, it's been devastating. We've destroyed the middle class in this game. We have 55 million people on food stamps. We have 96 million people outside of the labor force that should be in the labor force. We can keep going on. Financialization has completely and totally gutted the U.S. economy to the point now with the debt levels that we have, we can't sustain it. And I've done many examples, Charles, which showed you globally with the amount of debt we have at $220 trillion and the debt service payments on it, based on a global economy of $72 trillion and a growth rate of maybe 2%, and I think it's less than that, there's insufficient wealth being generated to pay the debt globally that's now built. That's how big the problem is. And so now what it is the way you pay it is you keep leveraging up with more using collateral to borrow money, which it's kind of a fictitious game, until suddenly there's not enough collateral. And in other words, you're not creating enough wealth to even create debt. And that's the problem we're now in. What happens when the collateral values start to fall? I have a chart here, our last chart, Charles, that really graphically shows, the difference in mortgage rates versus house prices. So as mortgage rates have went down, house prices have went up. That's the same as when bond prices go down, yields go up. It's the reverse relationship. It's how it works. So we've had, and this chart shows you that we've had interest rates falling dramatically, as we said earlier, since the Volcker era in the 1980s, and why that was. But you'll also notice on this chart, every time we've had any kind of increase in interest rates, it always ends at some different points, depends how far they can get with the increase. Maybe it's going to be only 2 this time or 3. It ends in a financial crisis, and because of this increase in the size of the debt. And today, with the magnitude of debt we have and the amount of over leverage and rehypothecation that's going on, it could be devastating. But you can be assured, Charles, that there's more that will be done by the central banks. You'll be shocked at some of the things that they're going to change to keep this game going. The most blatant is you've got the central banks now buying the stock market. Japan, 65% of all ETFs are owned by the Bank of Japan. The biggest buyer of the FANG stocks, Facebook, Amazon, Google, etc., in the last 90 days has been the Bank of Switzerland, 20 billion on the last report, just in those particular set of stocks and a few others. And I could go on. I think there's 10 central banks now that are aggressively buying the stock market. So it doesn't mean this will go on and they will play more games, but it becomes unfixable. You're completely gutting the system for any chance of getting out the other end in some kind of a fashion. When it breaks, it'll be devastating, but it does not mean it's about to happen tomorrow. Because as we get closer, and I could give you a very strong argument, Charles, that it's imminent. But what I have found is every time it's imminent, they change the rules. It's like a game of Monopoly. And when you were a kid and you played Monopoly, one of your players had to be the banker, right? And that's how the game played. He counted out the money and was also a player. But what happens, and I had a brother who always liked to cheat. Some people like to cheat. And we never allowed him to be the banker. So that was one of the first rules. He couldn't be the banker because he would always have money that came out of nowhere. And so in many ways, that's what the government and the banks are together. They will cheat. They will change the rules. They will do it until there is no system that we really have that's working. I don't mean to be cynical, But we've been watching this unfold for 25, 30 years and been screaming about it. But every time they take it to another level, you're just in shock and dismay. And I called it, I have a chart here, I laid out, I guess started it in 2008, 2009. I said, we're on a road to monetary malpractice. And laid out what I thought was starting to unfold: moral hazard, unintended consequences, and eventually it's going to lead to dysfunctional markets, where it's delusional malinvestment. And by the way, we're here. But I can remember when we were back with malpractice and deception and moral hazard discussions you and I had back in 2011, 2012, we were stunned. So, what's the next level? Now I got to figure out how to update this chart, because I think it's going to another level.
Right. Well, Gordon, I'll make two last points on your chart here of the false view of wealth, showing interest, the mortgage rates, and the value of housing. Is that what we've seen is all these trillions of dollars globally have created asset inflation, right? All the assets like stocks and bonds and real estate have bubbled up. And the point here is a house provides a utility value of shelter, right? And so that utility value doesn't change. But what's changed is the market value has been pushed into the stratosphere because of all this debt and leverage. And so the system now depends on these asset bubbles for its very survival, because now insurance companies and pension funds and 401ks and the whole infrastructure of our financial system now depend on these elevated asset prices. Because if asset prices decline to what might be considered a more rational value, that wipes out a vast amount of wealth that's required to keep the system going. And so all this money has had inflation, not necessarily in the cost of eggs and bread, although there's some of that too. It's in asset inflation, and now the system is dependent on asset bubbles. And then my other point is the crisis never ended, and we know that because if the crisis had ended, why are central banks putting in $300 billion a month? And so what we're told, and in the old days before financialization dominated the economy, if there was a financial crisis, the authorities could increase liquidity or drop interest rates for a few months. And that was a temporary measure. And then they would quickly restore and let the market set the correct interest rates and the price of insurance and the value of risk and all those things that are set by markets. Now we've never allowed the market to find the price of risk, interest, collateral. It's all been manipulated, and it's still being manipulated to the tune of $300 billion a month. And so the crisis has never ended. They've never let the market rebalance, and that's how you create a very unstable system, a very fragile system. And they've hollowed out not only the real economy, they've hollowed out the financial system as well. Now we have two hollowed out systems that are extremely fragile.
We've got Charles. We've got this a fragility that we've never seen before on a global basis, overlaid on top of a financial system that has become so complex. There are very few people who really understand all the intricacies of it. Overlaid in multiple countries and central banks trying to control various part of it without any central standard working plan or structure to get quick and rapid information, which is a problem when you have a lot of centralized decision making at the various countries. So you got all of these complications, and now we suddenly are facing something that we haven't had in 8 years, and that is a recession. So these central banks and what we've had with financialization, have never been strong enough to overcome the business cycle. And the business cycle itself, usually we have a downturn called a recession, or it could be even worse, every 5 to 7 years. We're now at 8 years. The longest in recorded history, in time, modern era, has been 10 years. So the chances of the business cycle, and I believe it's already turning, my opinion, with the credit cycle, and the credit cycle has already turned. is a downturn. And when that downturn, that complexity, that fragility, something will break, and their ability to react to it quickly enough is going to be problematic. But when that happens, and I can almost assure you that that's what is going to happen, what will happen is the central banks and the powers to be will come out with another set of plans to kind of hold it in place, like we did in 2008. Did not fix the problem, to buy us more time. We'll go into asset guarantees. There's the helicopter money. There's a raft of new ways that printing money will take into. But all it will do is it won't stop the business cycle. It'll just be at a lower level with another little bounce. And could possibly buy us more time. I suspect that's what we're going to have. I could be more cynical and said it'll just crack, fracture, and like a dam will just explode and the water will rush out. I'm not sure that's what's going to happen quite imminently, but we'll see. I think we should pray that they can buy more time. What I do know, Charles, is they can't fix the problem. This problem is not fixable any longer in the current structure and belief of a capitalist system. We're no longer in a capitalist system. We're in a credit system. And we now don't have capitalism. We have, my friend Richard Duncan talks about creditism. And credit can only last as long as you have collateral. And we no longer have collateral. And that's the problem, because collateral is about wealth creation. We're not. Anyway, we have to wrap. I didn't mean to get us off track a number of times here, Charles. Any closing comments you'd like to make?
Just, Gordon, that all the dynamics we've discussed, in my view, are mutually reinforcing. And that's a critical dynamic to understand, is that each of these hollows out the real economy and the financial sector, but together they accrete. They actually become a much more powerfully destructive force together. And so you can't look at each of these in isolation and understand the total impact. You have to look at how they mutually reinforce each other in extremely negative ways. And that's why we're looking with such sobriety and concern at the next 5 years.
So I think that as negative as our comments could be taken, there's 2 points I'd like to make. On the world will not come to an end. On the other side of this crisis and the reset, there's going to be fortunes that will be made by those that were prepared properly for the crisis and the inevitable reset of a system that has been put into this kind of peril. The second point, which probably is really the first because it precedes it, between now and then, when you know what the central banks and the government are now forced and locked into, they have almost no choice now. As we've laid out these steps, you can start to anticipate the kinds of things they will do. And if you look at the big funds now, the ones that have had a bear of a time, hedge funds have had a bear of a time, but some have done extremely well because they're now betting on what they see the banks to have to, or the government banks having to do in the next step, and they're playing the game, and they're not even looking at valuations. They're not looking any longer. They're worrying about regulatory arbitrage. They're worrying about what the banks will guarantee. And we did a whole show here a while ago, Charles, on the student loan business, the $1.4 billion student loans and the $140 billion that's being sucked out of it every single year, and knowing that there's going to be a big payday as the government has to pay out. Well, there's 25 or 30 corporations that are in for a big payday, and a lot of people. So that's the game that's being played today, and it'll get worse. I suspect it's going to get worse over the next 3 years, if there is 3 years before this breaks. It's anybody's guess, but it will break.
Absolutely, and I think that's a good point to end our discussion. And thank you very much for allowing me to contribute to this huge and important topic.
Charles, hopefully next month we'll have our technology back in place, so we can go back and forth here in terms of the video. But enjoyed it, and we'll talk again next month.
Okay, thank you, Gordon.
Thank you.